Howdy. A video about mundane stuff like money. Some have it, some don't. Market Watch, deep dive, opinion. The stock market is in trouble. That's because the bond market is very close to a crash. Larry McDonald expects an abrupt policy change by the Federal Reserve. There's a bird. Investors have had few places to hide in 2022 from the Federal Reserve's hawkish monetary policy. So, since the age of Pisces is about to be over, and we had the pigeon, the dove as a sign for it, maybe the next one will be a hawk. Who knows? Referenced symbols. Don't assume the worst is over, says investor Larry McDonald. There's talk of a policy pivot by the Federal Reserve as interest rates rise quickly and stocks keep falling. Both may continue. McDonald, founder of the Bear Traps Report and author of A Colossal Failure of Common Sense, which described the 2008 failure of Lehman Brothers, expects more turmoil in the bond market in part because there is 50 trillion more in world debt today than there was in 2018. And that will hurt equities. 50 trillion more world debt. So we have probably to assume that our modern way of life with stock markets and all these kind of things doesn't work. I cannot get the word in my head. Commercialized everything. Capitalism. Now I remember. Yeah. It seems that it doesn't work. Like 2018 and now it's 2022. So 4 years and they managed to make 50 trillion more world debt. What an achievement. Thank you, adults. But anyway, let's go on. I haven't read this yet. The bond market dwarfs the stock market. Both have fallen this year. Also, the rise in interest rates has been worse for bond investors because of the inverse relationship between rates, yields, and bond prices. Whatever that means. Something is obviously very wrong. Anyway, probably fundamentally wrong. About 600 institutional investors from 23 countries participate in chats on the Bear Trap site. During an interview, McDonald said the consensus among these money managers is things are breaking and that the Federal Reserve will have to make policy change very soon. Pointing to the bond market turmoil in the UK, McDonald said government bonds with 0.5% coupons that mature in 2061 were trading at 97 cents to the dollar in December, 58 cents in August, and as low as 24 cents over recent weeks. Oh, that's quite a drop. When asked if institutional investors could simply hold on to those bonds to avoid booking losses, he said that because of margin calls in derivative contracts, some institutional investors were forced to sell and take massive losses. Investors haven't yet seen the financial statements reflecting those losses. They happened too recently. Write-downs of bond valuations and the booking of losses in some of those will hurt bottom line results for banks and other institutional money managers. Interest rates aren't high historically. Now, in case you think interest rates have already gone through the roof, check out this chart showing yields for 10 years US Treasury notes. Thumbs 10 years. What is that? 3,908%? 3.908% over the past 30 years? Yeah, I don't know anything about money. The 10-year yield is right in line with its 30-year average. Now look at the movement for the price to the earnings ratios for Standard Poor's 500 SPX minus 66, 0.60. Yeah, that's obviously changing in real time. Since March 31, 2063, which is as far back as fact sheet can go for this metric. So we have records for 22 years. This index weighted forward price to earnings ratio of 15.4 is way down from its level 2 years ago. However, it is not very low when compared to the average of 60.3 since March 2000 or to the 2008 crisis bottom valuation of 8.8. Then again, rates don't have to be high to hurt. McDonald's said the interest rates didn't need to go anywhere near as high as they were in 1994 or 1995, as you can see the first chart, to cause havoc. Because today there is a lot of low coupon paper in the world. So when yields go up, there is a lot more destruction than in previous central bank tightening cycles, he said. Cycles. There's a cycle in that. Anyway, it may seem the worst of the damage has been done, but bond yields can still move higher. Heading into the next consumer price index report on October 13th, which is in 2 days, strategist Goldman Sachs warned clients not to expect a change in Federal Reserve policy, which has included 3 consecutive 0.75% increases in the federal funds rate to its current target range of 3% to 3.25%. The Federal Open Market Committee has also been pushing long-term interest rates higher through reduction of its portfolio of US Treasury securities, after reducing these holdings by $30 billion on a month. In June, July, and August, the Federal Reserve began reducing them by $60 million a month in September. And after reducing its holdings of federal agency debt and agency mortgage-backed securities at a pace of 17.5 billion a month for 3 months, the Fed began reducing these holdings by 35 billion a month in September. So what, 60 plus 35 is 95 or 75? That's over 100 billion. So capitalism doesn't work. There is something profoundly wrong in that. I won't read anymore because that's boring stuff. Not boring, but it's not my thing, but I just ran across this. For all those, if there's anybody listening who has money, be worried. It's coming down. The bubble will burst. And I was also thinking about the electricity shortages, which were talked about in Europe and all over the place. When they have to evaluate what is important, if there's a hospital and some stock market place in the same town, And there's just electricity for one of those. In which of those two places will stay the lights on? The hospital or the stock market? I don't know. This is something the adults have to decide, the people in charge, which are elected by the people. They say. But anyway, this is probably something which we'll figure out later, when it gets colder. And maybe we can even share it still, if we still have internet and all these kind of modern things we are used to, which are too often taken for granted. Yes, that's one reason I'm making this video, because I still can. And for those few who are listening, you still can listen to this. I don't know. Why listen to me? I have no idea. This is interesting. But anyway, stock markets coming down, it's crashing down. There has been some big problem yesterday, I guess, in Switzerland, where people couldn't pay in shops for the whole day or something. I don't know if it was possible with cash, but cards didn't work. And for those who fear digitalization, everything gets digitalized. Yeah, that's probably their plan, but they didn't take a few things into account. Earth's electrical circuits and how much energy can be provided just alone by our sun. And obviously the sun is ramping up. We have been lucky again. The Earth facing sunspots didn't do anything. Now they're turning away. Maybe they now start to get active, which could be still enough to set us back into the Stone Age. Takes 8 minutes for a flare to reach Earth. There's no possibility to prepare or to tell anyone. It's here and gone before anybody knows. And that's the wind howling. But anyway, thanks.